Salutations, this is Brian Jarris from Ville Wealth Management. In today's video, we're going to talk about the Shoebox Strategy. This strategy basically lets your health savings account act more like a Roth IRA during your retirement years. Now, Ville Wealth videos are meant to be educational only, so if you need customized advice tailored for your situation, please reach out to us at villewealth.com. When you open a health savings account, you can only use the money for approved healthcare costs. If you use the money for other things, you must pay income tax as well as a pretty hefty 20% penalty. But that penalty does go away at the age of 65. Now, if you're married and you pass away, your spouse will inherit the HSA and can take tax-free withdrawals for healthcare expenses and not have forced withdrawals, also allowing that money to continue to grow tax-free. But if someone else inherits your HSA, like your children, for example, they'll be forced to pay taxes and withdraw the entire amount all at once. So because of this, health savings accounts are great for healthcare expenses during retirement, but not so great for estate planning. Let's go over annual contributions. Now, HSAs are individual accounts, but if you're married or have children, you can contribute up to what they call the family maximum. Now, in 2025, the individual limit is $4,300. If you're married or have children, the family maximum is $8,550. Once you reach the age of 55, there is a catch-up contribution of $1,000. There's also a spousal contribution of $1,000 when your spouse reaches 55, but they must contribute that to their own HSA account. We'll go over an example of this in a little bit. So what are some common medical expenses covered under your health savings account? Things like common or routine medical expenses, over-the-counter medications, emergency service expenses, mental health expenses, even long-term care insurance premiums, but they were no longer deductible, COBRA insurance premiums, and dental and vision. So what are some examples of things not covered? Things like your nutritional supplements, gym membership, cosmetic surgery, as long as the doctor does not deem it medically necessary. So when it comes to Medicare, what can you pay out of your health savings account? You can pay deductibles, co-insurance, co-pays, and premiums for parts A, B, C, and D. The one that you can't is Medigap, which is supplemental insurance. Now be aware that your Part B insurance is typically deducted from your Social Security check, so you would need to reimburse yourself after the fact for that situation. So let's go over the Shoebox Strategy. So instead of utilizing your health savings account to pay for qualified healthcare expenses, instead pay for them out of pocket and save those receipts. Archive those receipts, preferably digitally, so you could use them years down the road, because there currently is no time limit for reimbursing yourself for prior qualified healthcare expenses, as long as the HSA account was open and active before the expense occurred. So now you can invest that HSA into a growth portfolio because you have a longer time horizon. Then in retirement, you can pull that money from your HSA tax-free, utilizing those older receipts. So for example, you could buy a car from your HSA account, linking those to past medical costs and expenses. Now at age 65, pulling money out of your HSA for non-qualified use, the penalty goes away. So it basically kind of acts like a traditional IRA, except there are no required minimum distributions. And if you use the Shoebox Strategy to pull money out utilizing those receipts, it's tax-free. So it kind of acts like a Roth IRA. And as always, you can always utilize your HSA before or after 65 to pay for qualified expenses tax-free. So let's go through an HSA example. I like to call HSA accounts the triple tax because they're tax deductible, tax deferred, and tax-free withdrawals as long as you're utilizing them for qualified healthcare expenses. So let's go through an HSA example. We have a couple, both age 50. Let's assume four things. Number one, let's assume that they are maxing out their HSA contributions for the next 15 years. They're going to pay all of their current healthcare expenses out of pocket and invest in that HSA account in a growth portfolio. Let's assume a 6% rate of return. Third, they're going to save and digitally archive all those receipts. And then fourth, later in retirement, they're going to utilize those receipts for tax-free withdrawals. Okay, let's go through in the actual example. Let's assume we max out the family contribution of $8,550 all the way through age 65. Remember, at 55, we have that additional $1,000 catch-up contribution. And we also have a spousal catch-up at 55, but that one needs to be in its own separate account. So if we add up all the contributions, we're at $158,800. At a 35% marginal tax rate, we basically saved over $55,000. Our growth on that portfolio grew to $105,610. At a 20% long-term capital gains rate and a 6% annual growth rate, we saved over $21,000 for total tax benefits of over $76,000. So unlike a 401k, the withdrawals in the retirement could be tax-free with no required minimum distributions. This really serves as a valuable tax diversification strategy because if we have higher expense years or higher tax rate years, we're able to leverage that money from the HSA accounts by saving those receipts. Now, as always, please consult with a qualified tax advisor about your own personal situation. Thanks for watching this week's video. This is Brian Jarris, CFP from Vil Wealth Management. If you want to get a hold of me, please reach out to me at vilwealth.com. Thank you and have a great week.